2019, and it's 9:41 a.m. in London when we're doing this live market update. Join me in the chat, guys. Free to ask any questions about the market, so just say hello. We're gonna take a look at the markets. It's interesting to see how the market reacted following the non-farm payrolls on Friday, and I'm gonna talk a bit more about that, of course. Before we start, though, as always, I need to stress that trading financial markets, unfortunately, is high risk, and we may lose all of our invested money. Now, let's take a look a bit at the data, right? So, this is the non-farm payrolls from the US, and the forecasted number was actually about 140 or so. And you can see here how the prior number was revised lower as well to 72,000 from 75. Now, what's interesting is you had that very weak number, 72,000, in the month prior, and a few months before that, we had 33,000. It has a very weak numbers here. Maybe because of the government shutdown, maybe because of, well, government shutdown, I think that's probably the most likely thing. And I was myself suspecting that we're going to have a rather weak reading. Instead, we have a strong reading. And it looks like the stock markets were right all along, because, you know, the stock market has been going upwards, right? It's sort of ignoring the bad PMI data. It doesn't mean, though, that you can't have bad data later, but clearly, sort of for now at least, the numbers looking good. And you had a significant bounce there. And if we take a look at the unemployment rate, I think it did tick higher a little bit, but not by much. Hourly earnings still a solid 3.1%. Unemployment rate, yeah, pretty much. I mean, it's very good, 3.7. You know, you can't really complain, can you? So, stock market wise, which I think was the most interesting, you had the S&P 500, and that one declined. So here's the data coming out more or less here. You have that decline, and I was thinking to myself, oh, what a weird market. You know, it's good data. Maybe it was priced in. Okay, that's fair. But even if it was priced in, you know, why would you sell on the back of that? I found that a bit weird. I understand that people say, okay, good data, maybe the Fed is not going to cut rates. They're still going to cut rates. It would be silly of them not to cut rates. What they might do, though, they might just cut once. So they might just cut once now, and then they're going to say, oh, the data's good, let's take it easy. I don't think so, though. I think the inflation rate is low in the US, and that's the main reason why they're not really raising interest rates. Oh, so maybe they'll say we're gonna cut once, and then they're gonna wait, and then we're gonna see what happens. That's what I think. So when this market declined, I was finding that a bit surprising, because it shouldn't be the Fed cuts rate, the market just go upwards. Because the idea is this: they cut rates, and then eventually the economy should be able to gain by itself, right? And if you think about it, U.S. interest rates, let's see if I can load that, U.S. 10-year interest rates, they've been declining for a long time. So this is your daily chart, and in the beginning of November 2018, the interest rate was at 3.22. The market is now at 2%. So what happens here is that the actual ability to borrow money, it's become cheaper to borrow money, at least for the US government, by some 37% cheaper to borrow money now, because anticipation of rate cuts. Because the markets here, they're clever, right? When everything is good, the market goes up. But when the market starts to believe that, okay, this is probably what we've seen, this is sort of the best what we've seen so far, then the yield starts to go down. And then by the time that the Fed actually cuts, the yields can continue to trade lower if the data deteriorates. But what's happening here is that the effect has already happened, at least on the longer term government bond yield. And then let's see here. I think the 2 years should pretty much be. Let's see if we can load this one. I don't know if we can load it here actually. I don't think I'm gonna find it here because I don't actually know it on top of my head. That's a treasury note. There we go. This is the 2-year government bond yield, which 2-year government bond yield, yes, which is actually more sort of for short-term loans. Is relevant. So here it's also collapsed for about 37%. So it was at 3% at one point. Now it's at 1.85. So these effects are already influencing the stock markets before the actual rate cut has actually happened. And the idea is rates go lower, central bank cuts, and then economy comes and economy strengthens, and the economy creates jobs, more business, more money, higher stock markets. So that's when I saw this. I said, okay, this is weird. Anyway, the market declined. This would have been, I think, at least a good opportunity to get involved. In the short term, we talked about this last week as well. I said this is probably a good buy area from 29.75.2. It jumped nicely. So when we had the close, the market was already up here, which is good close. And now, of course, not of course, but we are revisiting that low. And I see no reason to change my bias. We had a breakout, because you can see already here on the weekly. So you have that breakout that happened already last week. And as long as you trade really pretty much above last week's low with the levels I shared with you guys, this will be a completed breakout, and you have head and shoulders here. Now I know I have this gloomy outlook, but I'm not going to start to fight the stock markets, especially not when they are suggesting, when they're providing me with such a great opportunity, a great technical opportunity. As for the euro, that slide did make perfect sense to me, at least, because what we said last time is that the market is trading sideways between 111.05 and 114.46, and the idea here is that when we're in the middle, there's no real incentive for people to buy or sell. And then, of course, when the data comes out and the data is bad, the market declines, which makes sense. We'll go down to 111.83. I think from here, maybe people might start to look to buy again, because we're dealing with a range-bound market. As for the pound, things are starting to become really interesting now. So conservative members are now voting, or I think the voting has already started, who's going to be the next Prime Minister and Tory leader. Well, most likely Boris Johnson. As we know, they're quite happy to take the UK out from the EU with no deal, if that is what needs to be done to get out. And that obviously is putting pressure on the pound. Now the pound here is trading within the sideways here against the dollar, and I'm thinking that if we slide below the low here from December 2018, that we're probably going to trade lower. So that's really what I'm looking for, and there are different ways of dealing with this. Just trading below it is probably not going to be sufficient. You probably need a close below the level, and if I would short say today, then I would like to see a break to 24.50, probably down here. So when and if we have a pullback, we only pull back to 25. So that's really what I'm looking for. But we have not traded below that level yet, so let's not get carried away. The market could spend a few more days trading just above this level. As for the dollar yen, so with stock markets being really or bullish, with the economic data being okay, the market actually traded below my trend defining level, and it looks more now like a inverse head and shoulders with a head, left, right shoulder. And then you have sort of the break to this level here. So on a break to 108.73, this could probably go upwards. As if you were still short on Friday, it's better just to accept the loss, I think, and let's see what happens. I prefer that move. If you happen to be really, really bullish and you think this is going to catch up with stock markets, there may be a 50% dip or dip to the third fib and then turning bullish about 104, 107.50. For the short-term downtrend now to resume, we really have to trade below that level. If we take it out, this will be what we call a fail head and shoulders, and suddenly we'll do something like that. So 107.50 is that short-term trend defining level. Gold prices. So I mean, they're holding up for now. Still looking okay. The trend is bullish about 1380.87. The market slid quite strongly, and with the numbers looking good, does it make perfect sense, that we're going to see sort of a significant push to the upside with the economy improving? I'm not sure. I remain bullish for now, though. The technicals remain bullish, and I'm gonna stick with this one because there are many reasons why this market can increase. I remember many years ago, say 10 years ago, people said, well, you buy gold because of a hedge against inflation. That used to be sort of the old truth. And then people say, well, there's no inflation now. But then they said, yeah, but they're gonna do QE, and that's gonna raise inflation. Obviously, that didn't happen. We didn't have rampant inflation and just going crazy. So I'm not sure about the theory. People, though, as market goes up, they're gonna make up a good story for this. I can't tell you what that story is right now. Maybe it's the situation with Iran and the US. Maybe it's just the Fed cuts. I'm not sure. But I can tell you this. The break to the upside here, the break to 1375 level that we talked about, this is bullish and we're still above that level. If we trade below last week's low, we're probably going to go deeper into this move here. And then the trend is still going to be bullish on the weekly because you see you have a low down here and another low here. So people might say, okay, I'm just going to be buying here at 1340, 1350, and then look for that move. And yeah, that's probably the right move to do. However, if you like me and you're already long, then just focusing on a break to, again, last week's low is going to be enough, 3080. If that fails, yeah, it can go lower. But we made a decision here, as you know, to treat this as a sideways market for now, between these levels, and I'm gonna stick with that. Crude is slightly upwards. So you've probably seen the news that Iran is gonna breach those limitations that they have on their uranium processing for their reactors. They had a deal with the US, as you know, and then with, I think, Russia, China, the EU, so Germany and France. But now they don't really feel that they're getting any support from the Europeans. So they said, look, we just need to do what we need to do. So we're just gonna process more uranium and process it to a higher level. Obviously, there are fears that this could be pushed up to for example, make a nuclear bomb. I think the actual is how much you enrich the uranium. I think the enriches to 3.5, 3.75, but I think you need to push it up to, I think, about 80 or 80% to make an actual bomb, and you need to have like 1.5 ton of it. But right now they only have 300. They only stockpile up to 300 kilos. So from that, at least, it looks like we're far away from doing they're far away from doing anything. But we don't know how the people's gonna react, or the market's gonna react. For now, though, there is not too much of a reaction, if any reaction. But you need to be wary that maybe the US government is gonna issue a statement, or maybe the Europeans are gonna issue a statement that's gonna increase the stakes here and could potentially cause this to go upwards. So I'm not personally never enthusiastic, and technically here I'm never enthusiastic at all about this pattern. I personally think the market will just trade sideways between 50.53 and 59.70, and yes, it's possible to sell here for this to go down, but in the light of what's going on right now, you just need to be very careful. So any comment from Trump or statement from the US government could see price up here, and then that trade will be over. As for the S&P 500, as I talked about this already, that day was to buy here. We tested that buy area again this morning. That could have been an opportunity to go buy again. And I'm going to take that trend of funding level. I'm going to stick it below the low here, when and if we take out 3,000. As for the German DAX, the German DAX is going down a little bit, and I think it makes perfect sense to be cautious here. I think we'll probably either we're going to stabilize here, but most likely go lower so people can get that good risk reward ratio. I don't think they want to be buying up here, and that's why we're seeing this. Reminds me a lot about what we've seen recently when the market went up and then continued to go upwards without correcting. Eventually it did correct. It's the same thing here. Went all the way up, then people got greedy and they didn't correct. So now we're correcting lower. So people that bought here, they're now nervous. Some of them are probably going to sell. That caused the price to go down, and then down here at the lows, much like here, I think people are going to buy. Okay, Let's see if you guys have any questions. So John Mitchell says, good morning and successful trading in the third quarter. Thanks so much, John, and I echo that. I hope you guys have a good quarter. What's starting to become clear to me, actually, is that if stock markets properly break out here, that's really where I will be focusing on. It's quite interesting. You see the Dow Jones very close to those major levels. The S&P already broke. You have the French stock market very close to the highs, and then you have some other stock markets moving upwards. As for the currency markets, my overall view is that Eurodollar is probably going to trade sideways. As for commodities, you have gold, but the other complex with with commodity, with copper and stuff, is not really doing too much. Crude oil as well is not doing too much. We have Marvin here. Good morning to you, sir. I hope you're doing well. So I think we're gonna wrap things up. We don't have any questions. So guys, don't forget to as well become members of Investing Cube if you want to, of course. We do have some content here that we're gonna share, and we also have a new guy hopefully joining today. That's gonna publish more content in the afternoon from about 11 o'clock until 4 p.m. He's gonna do like a bit of a test run this week. If it works out well, he'll be on full time not full time from those hours just discussed, starting from next week. And pretty much everything is open now, but actually not everything. So most of the stuff is open, but some 30% of it is locked, which just means you just need to register and then you can read it. For example, on Friday, I produced an outlook, like a trade idea, which is this one. Ignore the Eurodollar, watch this pair instead. So it's free to join. You just need to register, and you register once and you can access to everything. Because when you log in, you don't see these login buttons. That's why we have the quarterly outlook, the Q3. That's gonna be uploaded hopefully later this week, so you can take part of that as well. Okay, we're gonna wrap things up, guys. Thanks so much for watching, and don't forget to like the video, and don't forget to join me tomorrow, same time here. Just bookmark this link, and around 9:30, I upload. We'll start the webinar. Have a great day, and I'll see you guys tomorrow, same time. Bye bye.